And I wanted to start off with the economy, and I want to get your opinion on this. I mean, we've been in this recovery for 10 years now, and we can see the GDP numbers. They're, through the roof now. I mean, they've done a little manipulation. They changed some things, and now we're getting like 4% GDP. Unemployment is very, very low. From everything that you've been looking at and from your research, since the Great Recession of 2009, has much changed? I mean, is the economy stronger, better, and doing, a lot better than we've ever done before?
Well, I'm sure it won't shock you that I'm a skeptic of that whole narrative, and the basis of my skepticism is shared by a lot of people, which is how are the households doing? Like we all know GDP is great and corporate profits are great, and the stock market's tripled. But what about household wealth? How about household income? Because we're a consumer mass economy, right? Mass consumption by 150 million households. That's what keeps the economy going. And if we look at those numbers, we find that the average wage or the median wage is stagnated for the entire 10 years of recovery. And what's skyrocketed is, of course, assets, right? Lots of houses have gone up 50%. Stocks have tripled. Bonds have done really well. Junk bonds have done great. I mean, lots of all the assets have inflated in value, but we haven't seen any inflation in wages that have made that are meaningful. We see like 1.2% or something, like everybody makes $6 more a month or something. I mean, obviously that mismatch is at the core of our the economic weakness. The money is not flowing to labor and earned income. It's flowing to assets, and then that creates bubbles, which are then prone to pop.
So you are definitely seeing bubbles in the economy. Are the bubbles still inflating right now?
The bubbles are, if they're not still inflating, they're rolling over, but we have yet to see any, significant declines in housing, bonds, stocks, anything.
The Fed is raising rates right now, and they're moving them up. And there's a lot of people out there saying that, this isn't a good thing. Raising the rates right now is not a good thing. Why do you think the Fed decided to raise the rates right now?
Well, that's an excellent question, because a lot of, in terms of finance and trying to understand the financial side of the economy, a lot of it goes back to the cost of money. Right, which is like interest rates and what you can get in yields on your savings or your bonds. In other words, the whole game here of the recovery was the Fed was going to drop interest rates by brute force, by just spending $4 trillion on mortgages and treasury bonds. Brute force push interest rates near zero, and the idea there was to lower the cost of money to the point where consumers would go, well, gosh, we might as well buy a new car. We can get 0% financing. And corporations were then supposed to borrow money and build new factories and train their workers and upgrade their software and do all these productive things. And of course, what corporations mostly did was borrow huge, trillions of dollars and then buy back their own stocks to push the stock value up and enrich the insiders. But that's another story. So the idea was we're going to create more productivity and bring consumption forward. And that's what they call it when, hey, your car might last another 2 years, but because interest rates are so low, you say, what the heck, I'm going to buy a new car today, even though I could wait 2 or 3 years. Well, what that does is, of course, it creates a hole. Eventually, it creates a hole in consumption demand, right? Because everybody's already bought everything they can afford or that they want. And then you get a cliff, right? There's nobody, no matter how low the interest rates are, nobody either can afford to buy or wants to buy anything else. And that's where people are going, well, this whole growth phase, all it did was strip out demand in the future, bring it into the present, and now we're running out of demand. So the Fed is trying to raise interest rates for a couple of reasons. One is to try to, quote, normalize the economy. In other words, like, well, if the economy is really going great guns, then we should be able to let interest rates go back to where they historically used to be. Like mortgages, were 6 or 7%, or even as high as 8, 9, 10%. And so, and auto loans were, 6.9 or whatever, not zero. So they're trying to normalize the economy so that they have some room to lower interest rates in the next recession. Because if you keep interest rates at zero, forever, then when you get a recession, you've got no way to spark new demand. But it's like there's a lot of unintended consequences, in the economy. There's a lot of feedbacks that the Fed's very simple tools are lower interest rates and provide a lot of liquidity, like put a lot of money, lines of credit out there for banks to borrow and then put it out into the economy. But those are from some pretty simple levers. And part of why the economy's kind of falling apart is there's unintended consequences.
So when they start raising rates, those people who are looking to purchase a house, those people who are looking to purchase a car, doesn't it affect those industries? Because now it costs a lot more to borrow the money, and people might say, hey, you know something, maybe I shouldn't do this, or it kicks them out of the market because now it becomes too expensive.
Absolutely. And of course, in the terms of housing, we've seen the prices just inflate terrifically along the coast, left and right coasts and markets like, Dallas. And so the affordability index is at really low because the prices have skyrocketed. Meanwhile, the cost of mortgages are going up, and quite a bit, right? Because I just read something online where somebody had an adjustable mortgage at 3.125, like 3 1/8, and now it's 5 1/8. Well, that 2% is a huge increase percentage wise, but I think we have to kind of cycle back real quick. Like, well, who sets the interest rates? In a free market, it's set by buyers and sellers of credit, right? Like, how much do I want to put my money out there to earn, and how much am I willing to pay in interest? And so the Fed basically manipulated it for 10 years to push it down. And so that's not a healthy market, though, because as the Treasury, the bottom line here is the United States government's running huge deficits, right, on the order of 500 to 800 billion a year in the supposedly best economy ever. So who's going to buy that 800 billion of new debt? Or maybe it'll go to $1 trillion in the next recession. Well, if the Fed keeps interest rates at so low that no sane person is going to buy a bond that pays 0.1%, well, then the Fed is the only one who's going to be who will stupidly buy all that debt at no yield, right? So that's another reason why they're trying to raise interest rates, is so that the federal government can run a huge deficit and private money will flow in and buy those bonds, because now they're paying 3.5% instead of 0.1%. So they're juggling a lot of balls here, but as you were saying, the cost is now coming back to the household and to the corporate level, and it's not a positive effect.
I mean, even with the government, right now we're paying like something like $500 billion of interest on the debt. If they raise the rates, can the American people keep up with the interest payments on the debt if they keep raising the rates? Clearly,
there's going to be a crunch time. And there's a couple of different theories, which, of course, you and your audience know well. One is that the Fed is trying to create inflation so that we're all going to be making more money and all of our assets are going to be going higher. And then it'll be easier for us to make our interest payments, which are also going up because we're making more money. But the problem is there's no wage inflation. There are some jobs that are paying more now, but they tend to be in the top 5% of the professional technical class. And so the top 5% has been doing very well in the last decade. Their incomes have been going up. They are the ones that own the assets that are inflating. But the bottom 90% is seeing very little in the way of wage inflation. So that's the problem with trying to get inflation to make it easier to make our interest payments. We're not making any more money, but our interest payments are rising. That's a combination that basically guarantees recession.
I want to circle back for a sec to when you said corporations are buying back their stocks. And because of, the easy money, they were able to do this. Now, Ron Paul is giving a warning that he thinks the market's going to fall by 50%. So we have corporations that are buying back their stocks. We also have pensions that, peg their entire investments to like something like 7 or 8%, but I think they've been investing in the stock market. If the market comes down by, let's say not even 50, by 20 or 15% or 30%, I mean, what's going to happen to corporations? What's going to happen to pensions?
You've pinpointed the great weakness in this whole recovery, which is basically the Fed engineered a recovery based on asset inflation. And their idea was if we push stocks up and we lower bonds, so that makes the value of the bonds that people currently hold go up, and we juice real estate, housing again. All of that's going to create what we call a wealth effect, right? People are going to feel richer. They're going to look in their 401k and their IRA accounts, and they're going to go, wow, I can spend more money because look how much I'm making in my retirement funds. But all of that was bogus because if you look at the traditional measures of stock values and real estate values, they're like no longer connected to reality. We have huge margin expansion where there used to be things like price earnings ratios and so on. By any measure, stocks are overvalued by somewhere around 40%. And other people like John Hussman point out that normally over the last 70 years, stocks tend to return about 6% a year, through recessions, good times, bad times. That's the average, right? Well, in the recovery, stocks have been gaining like over 13% a year. And historically, what happens when you get those huge appreciation periods, you get a decade of stagnant returns to balance it out. So, that's the other way of looking at it. Even if we don't suffer a 50% decline, if we drop, say, 30% and there's no recovery, they just stay flat for 5-10 years. That will also kill everybody like pension funds expecting, needing, demanding a 6 or 7% every year just to keep their head above water. And so what's happened in my mind is everybody's now become dependent on these asset bubbles. In other words, pension funds now depend on asset bubbles, and everyone's 401ks depend on it, and the government depends on bubbles now too. Because I just read, just as an example, the state of California, which I live in part time, 38 million people, basically a small country, right? Just like a lot of the big states. Half of the state income tax is paid by 150,000 people. Now that means out of like 20 million households, a tiny little sliver of super high income people pay most of the income tax in the state of California. That's by a lot of measures and a lot of different places around the country. That's the case. The government's depending on people cashing in stock options or selling their house they paid $200,000 for, selling it for $800,000, and then and so on. So everybody's now dependent on bubbles. Well, bubbles pop because these valuations are just out of touch with reality. And the same goes for housing, which I'm sure you've talked about many times. What if the standard bubble house in Dallas or Seattle or LA or maybe even in New York City, what if it falls by 30%? Well, that's great for potential buyers, but all the people that own that are suddenly, a lot of them are going to be underwater.
I mean, it also affects many other industries, especially new construction, where, you have lumber, you have copper piping, you have electrical. And if housing starts to fall like that, builders most likely will not build until there's a time where people can go out and purchase the house, because it feels like we have like the perfect storm happening. We have the bubble in the housing market, prices at all-time highs. We have interest rates rising. A lot of people are being kicked out of the housing market, if that's what we're talking about right now, just the housing market. So if people are being kicked out, that means there are less people looking to purchase, which means the sellers, they can't sell their houses, so they have to reduce their prices. And it feels like this is what happened back in 2008, 2009, when we were leading up to the Great Recession. It feels like we're repeating everything once again.
You're absolutely right, Dave. Nothing was actually fixed. All they did was lower interest rates and juice the economy that was already faltering. In other words, productivity's poor, wages have stagnated. They didn't address any of the big problems. Neither President Obama, President Bush, none of the leadership, left, right, center, really addressed the core issues here, that there's a huge imbalance between what labor's earning and labor share of the GDP, which has been declining for decades, and capital's return on investment, most of it borrowed, right, or speculatively leveraged. But let's go back to your perfect storm. There's another perfect storm here, which is everybody's bought stuff at these really sky-high prices that they're not really able to survive a recession. And there was a great New York Times piece a couple of weeks ago that was looking at all the empty storefronts in Manhattan. And there's like streets that are like half of all the retail spaces are empty. And when they looked into it, it was like what most people don't realize is a lot of the buyers of those, the commercial real estate, investment trusts and so on, they overpaid for those buildings. So now they have to have sky-high rents and long-term leases in order to, keep their head above water, right? Because they overpaid. Well, guess what? If you're in business, the last thing you want to do is pay sky-high rent and then lock yourself in for a 5-year lease. So That's why they're empty. Now, there's no way out of that except for all those owners to declare bankruptcy and be wiped out. Because you can't force somebody to start a business and pay $5,000 a month rent for some little cubbyhole in Manhattan.
So, what you're saying is not just in Manhattan, but I think a lot of the malls also, a lot of stores are closing down and we have a lot of empty space there also. And, there has been a lot of building of malls in the past. And I think we're seeing this all over the place.
It's retail Armageddon, a lot of people call it. And what concerns me, Dave, is that I see a lot of businesses that hire a lot of people, like cafes, restaurants, tourist industries. There's a lot of businesses that have hired a lot of people that are really not stable businesses in recessions. In other words, the first thing that people do in a recession, they tighten up. They no longer go out and spend $50 for lunch or whatever, and they stop taking tours and overseas vacations and all that stuff's going to go away in a recession because it always does. And I think we could see, millions of people laid off and they're not prepared for it, any more than the guy that bought the building in Manhattan and thought he could get sky high rents forever. So I'm concerned because people's their expenses have risen and they're not really prepared to see an income drop or a decline in their wealth or all the things we're talking about being inevitable.
And the central banks like the IMF, and we've also heard from the biz, but the IMF is reporting that we're headed for this second Great Depression. Now, normally we don't hear a central bank calling out that, hey, we're heading towards a recession, a depression. Most of the time they tell us, no, nothing's wrong, look the other way, because they're the ones who are controlling the economy. They're the ones who are, creating the currency, controlling the interest rates, and they don't want everyone looking at them. But what's very interesting is that the IMF is out there telling us that a depression is coming. Why are they telling us this now? Are they afraid of something?
Well, clearly there's for the IMF to veer from the everything's great narrative is significant. And I think one of the things that we need to bring up here is what's happening in China. And we all know that China is like the great growth story of the last 70 years, right? And I visited there a number of times. And when I went like 18 years ago in 2000, which there was already, China had been booming for a decade or so already, I looked around and I got to tour some factories and stuff. And all the equipment is from Japan, Germany. And my point here is China lifted the entire world. It bought a ton of machine tools and equipment from Japan and lifted Japan out of its stagnation. It bought a ton of stuff from Europe And it's sort of even, some stuff from the U.S. And so China's slowing because they've already done their thing. In other words, they've already built, every subway line, every high-speed train line. They've built, they've been dependent on a model that doesn't run forever, which is constructing huge numbers of empty apartments and ghost cities and all that stuff. And now their costs are so high that regardless of tariffs or trade wars, it's like manufacturers are moving to Vietnam or Cambodia or lower cost areas. So China's slowing, and that's affecting the whole world. And if China were to have a recession, I don't see how the rest of the world couldn't follow, because so many countries depend on China as their market.
Okay, so if China slows, they built everything. You don't think they were building this for a specific reason? Because they've been also accumulating a lot of gold. Same thing with Russia. Do you think they were using today's system to build everything and purchase a lot of gold at the same time at these very, very cheap prices to weather the storm, because they knew that eventually this system would not be able to go any further?
Well, a lot of people do feel that, and I'm open to that. In other words, the Chinese and Russian leadership, historically, you could make a good argument that they look longer term than democracies where everybody's got a 2-year timeline to the next election. Like short-term thinking it reigns supreme. But each of those countries has their own problems. Like China really needs to employ its huge, 400 million person workforce. And so they can have stable money with gold, but they really need jobs for those people. And if their export industry slows and their construction boom slows, they're going to have trouble socially, because there might be 40, 50 million people without work, and that's normal in a recession. But the Chinese government is more or less promised permanent prosperity, just like every government around the world, right? And there's no such thing as permanent prosperity. So a lot of the young Chinese people that we know, they've never experienced any recession at all. Officially, China's never had a recession since it started tracking data in 1992. So they're really psychologically unprepared for a slowdown. And that's one thing that worries me too, Dave, is real quickly, the Fed likes to think of itself, and Ben Bernanke wrote its book, patting himself on the back about what a hero he was for saving the banks and all the wealthy people. But now that political will has reversed against the Fed. The Fed is one of the most hated institutions because it's people finally, after a decade of people like you and me talking about it, it's seeped into the national consciousness that the Fed saved the super wealthy, not the rest of us, and that they're now don't have the political leeway to go save the banks again. There will be huge political resistance to that, and we also have the same thing with the pensions, which you mentioned real quickly. One quick fact. The California pension fund is CalPERS is one of the largest in the nation because there's it's a big state with a lot of public workers. Well, back in I think it was 1998 in the .com boom, the taxpayers in California contributed something like $150 million to the CalPERS, as the taxpayers' share of CalPERS investment fund, and now it's pushing $50 billion. Well, wait a minute, 50 billion from 150 million to 50 billion a year? And then you go, and the reason, and this is with a tremendous wealth bubble that CalPERS has scored huge gains in stocks, bonds, real estate. And even in the greatest bubble in history, the taxpayers are on the hook for tens of billions of dollars each year. Well, what happens when the bubbles pop? Then we're going to see a political crisis because the taxpayer is going to be unable to pony up another 10 or 20 billion and support the consumption that the economy needs. And so you're going to get a self-reinforcing recession. And this may be one reason why the IMF is talking about a Great Depression is you try to make sure that everybody's promises are kept, the promises that were made in the boom times. Well, guess what? Then nobody's going to have any money left to support the consumer economy.
So, I mean, if this does happen, those people that are expecting pensions, are they going to receive their pensions?
I don't see how they can receive the full amount they were promised because there's just no money. In other words, the state of California or the state of New York, they can't print their own money. And so all they can do is raise taxes. But as we're talking about, household income for 95% of the households hasn't really gone up very much. So you're kind of squeezing, trying to get blood from a stone there. And if you take the money out of the households as with higher state taxes and higher sales tax and higher property tax, well, then that takes away the money that people were counting on to spend to support the consumer economy. So it's kind of like either or. If you want to support the pensions and make sure everybody gets every cent that they were promised, well, you're going to have no consumer economy. Nobody's going to have any money to go out to eat, no vacations, none of that stuff. And then you have huge mass layoffs, and then the state revenues fall because you've killed the economy. So it's like there's no way out of that loop except a complete reset, that everybody's got to come to the table and go, this is not a boom time. This is a depression. We're going to have to, deal with reality here.
I mean, you mentioned before that people are waking up to the Fed and what they're all about and how they save the wealthy. And Trump is continually out there, and not many presidents have done this. And some that have, they were assassinated by a central bank or an attempted assassination. But he's out there continually contradicting the Fed about their interest rate policy. And he's saying he doesn't want them to raise rates as fast as they are. Why are they doing this? It's too fast. I mean, why is he contradicting the Fed out in the open like this?
Well, that's a very good question. And of course, we know Trump is, famous for tweeting all sorts of rambunctious stuff, right? And some of it hits the wall, some of it sticks, some of it falls off. But I think it speaks to my point that there's going to be a political controversy now about what the Fed does. It's not just a economic PhD's discussion. It's now going to have a very politicized impact because, as you say, if the economy's slowing and entering a recession, then the Fed raising rates is going to create a negative feedback there, that it'll slow the economy right when the economy's slowing for a bunch of other reasons.
Do you think Trump might be setting up the Fed to maybe nationalize the Fed or maybe audit the Fed? I know Rand Paul continually tries to push, just like his father tries to push the bills out there to say we should audit the Fed. Do you think he's calling attention to the Fed right now? So when the economy falls apart, everyone looks at the Fed and they're the cause of it?
Well, that's a great idea, and it's a narrative that we should keep on. And I want to make a point. It doesn't really matter from one point of view whether it's Trump demanding an audit of the Fed or questioning the Fed's policies, or it could be Bernie Sanders, somebody from the left. The point you're making, which is key to me, is that there's a political element now questioning the Fed's independence and the foundation of their policies. Like maybe they're not really good for the country. Now that's a big question. If the Fed is actually an enemy of the bottom 90% of American households, then why does it exist?
True. And if we audit the Fed, I'm sure, if it ever gets that far, hopefully it does, going into their books and finding out what they actually have done and where the money has flowed, people are most likely going to be very, very shocked because, we all have our theories of what they've been doing, but we haven't really seen their books. I think if that is opened up, I think people around this country and probably around the world will be completely shocked in what they've done here.
Yeah, and what little we've been able to cobble together, people who've studied what they did after the Great Recession, 2008, 2009, we know they put out $16 trillion into the global financial system, right, to the banks in guarantees, lines of credit, you name it. And some numbers have gone as high as 23 trillion. Now you're 16 trillion at a minimum. Well, that's like basically the size of the whole US GDP, at least back then. I mean, we're talking huge numbers. And so here we are with a falling apart infrastructure and crying need for, alternative energy and lots of other stuff. And then the central bank just gave away 16 trillion. Yeah. I mean, that obviously that should raise eyebrows and questions about why the Fed even exists. And frankly, if it was nationalized, I think it would be a step in the right direction, and you'd probably get support from left and right, because everyone, who can argue the Fed's been successful once the economy rolls over into recession?
True. I mean, if all you have to do is look back at their track record, and you'll start to, people will start to realize that they put countries into debt. Their whole system is based on debt. And the way I think of it is that we've been brainwashed to think that debt is good. Oh, look, credit card numbers are going up. That's a good thing. People are now charging more on their credit cards. Oh, student loans is going up. That's a good thing. Mortgages are going up. That's a good thing. I mean, if you really think about it, they brainwashed into making everyone in America and around the world think that if you have more debt, it's a good thing. That means the economy is prospering.
Right.
And to me, that's ridiculous.
No, you're absolutely right, Dave. And to kind of strike a fundamental point here is wealth and prosperity that's broad-based is all based on rising productivity, getting more goods and services out of the same amount of labor, capital, and energy, right? And so if you're just focusing on borrowing more money to buy stuff, your productivity's not going anywhere. And that's why productivity's been declining. And so you really have to make productive use of labor and capital. That's the foundation of prosperity. And we're not doing that. Just encouraging people to borrow and buy a bunch of stuff they may or may not need that's of poor quality. That's a way to follow the Roman Empire to collapse. You got to focus on a productive use, not just borrowing and spending.
Do you think we're on a schedule to have the whole system come down? I mean, do you think we're heading towards a crash of the economy?
I do. I think so, because I think all we did was exacerbate all the imbalances and distortions that we had 10 years ago. Now they're even worse. And so I think what's going to happen in the next, say, 5 years between like 2018 and 2022, 2023 is we're going to get a huge recession, depression with tons of unemployed people, debts that are going to default, pensions that are going to go unpaid, and there's going to be a political crisis. And the Fed, if it still exists, which it probably will, they're going to try to print their way out of it, and they'll just start giving away trillions to try to keep the economy afloat. But that will create inflation and rob all of us of our purchasing power, right? Because our money is really just, fiat currency, right? It's based on trust. And so if we, as people lose trust in paper money, and then the economy really will crash, and then we'll follow the path of Venezuela. And everyone says, "Oh, that can't possibly happen." Well, the people of Venezuela thought that too.
Yeah,
they were one of the richest nations in South America, and so you can't say it can't happen here. No, it will happen here if you don't deal with the real problems.